Hi, everybody. So I want to talk a little more detail about diversification and what that means. So essentially, diversification just means having a lot of different things in your money management plan, in your investing plan. And so essentially, what that can mean for you is that, at any given point in time in the financial world, stocks can be doing well, gold could be doing poorly. Treasury bills are pretty safe, right? And so generally, they're fine, but there could be things affecting treasury bill interest rates, where they're not earning as much interest, right? Um, so you could have Bitcoin tanking or Bitcoin taking off. You could have a particular stock falling apart. There can be all kinds of things that are happening in the financial world. So having investments in different places can help minimize your overall risk. So, for example, if you had all your money in the stock market, generally over time, it is true that the stock market has always gone up, generally. Okay. But it has had points in time where it's not been good. Okay. Now, if you get caught in one of those things where there is a financial collapse of some kind and all your stocks, all your investments are in stocks or invested in the stock market itself, you may have time to recover from that. And generally over time, you can recover from that. But generally, as you get older, you might very much diversify, the funds you have on hand and things like that. And I've sort of hinted to that a bit. Um, and I will tell you more and more of the strategies I've used, when I've used them, and why I've used them, um, and the ups and downs of my own experience in this world. But diversification is part of the key of being able to sleep at night, you know. And so having your money invested in stocks, invested in bonds, invested in treasury bills, invested in gold and silver, if you think that's a wise thing to do, and a lot of people do, um, then you'll take bits and pieces, pools of money, and put them in these different places, which overall, all of it might be going up, all of it could be coming down. There's no guarantees here. But generally speaking, if you've diversified your portfolio, you have a chance of being able to not lose everything all at once. Um, that has happened to me, which I'll talk about eventually. Uh, and I have recovered. I have recovered from it. So it's not like it can't be done, right? So diversification is a huge part of this. Now, mutual funds came along to actually do this in a fairly explicit way. So if you invest directly in a stock, like if you love Amazon and you really want to invest in them, you can get a brokerage account and you can buy your own shares. Okay. But the things that mutual funds tried to address was, hey, we've got access to a lot of money. A lot of people are investing in our mutual fund. They might have thousands of people who are putting money into a mutual fund. So they have millions or billions of dollars that they can invest in different companies out there. So there can be tech oriented types of mutual funds out there. That is great. They've often returned a great amount of money to investors. Okay. So it makes sense, right? To be invested in technology stocks, usually, But if you're investing in Amazon itself, if something catastrophic happened to Amazon for whatever reason, um, you could lose all of it, where in a mutual fund, you know, there are professional money managers who are managing that fund and they're keeping tabs on companies all the time as to what they include, they don't include, you know, they might be in this company now, but they get out of it and go into some other company for whatever reasons. They are actively managing the fund. You can be a little bit more passive as an investor and know that you're probably not going to lose everything all at once. right? So no guarantee of it, but you know, so in a tech-oriented mutual fund, which is typically oriented on growth, growth of the value of the stocks as well as whatever income comes off of those stocks. Those carry a little more risk than, say, an income-oriented fund that is totally focused on dividend income. Of course, they would like the portfolio to grow from a growth perspective, but they're not looking for massive 20% growth or anything like that. Like if you look at companies like Kraft Heinz, I think the growth rate for Kraft Heinz is a very moderate, relatively small, like maybe 5%, maybe. It might not even be that. But they do grow. They do grow their income. They just do it at a lot slower pace than, say, a tech company can do. Okay. So being able to look at a mutual fund and see all the different companies that they're invested in, it gives you some measure of diversification within an instrument, within an investment instrument. So I wanted to show you one just so you could kind of see what I'm talking about here. So early on, when I started investing in mutual funds, I invested in T. Rowe Price. And T. Rowe Price, if you go to their website, if you click on this tab where it says Enterprise, go down to Personal Investing, which is where you would want to look. Okay. And then once you're there, there's a little menu across the top here where it's got account types, funds, advice, et cetera, et cetera. So click on the Funds tab, and then you can view all mutual funds. All right. So now you've got a screen that will allow you to look at various different things. And all I'm going to do is down here, there's a list of the different funds. Like the very first one that I see is Africa and Middle East Fund, but it doesn't have a Morningstar rating to it. So on that column where it has the Morningstar rating, I'm going to sort that so that I can actually see what are the top rated funds by Morningstar. Okay. So you will see now that the Capital Appreciation Fund is one of the highest rated ones. It's showing that for year to date, it's returned 13% to investors. In 1 year, it's returned 22%. In 5 years, 11% on average, almost 12. So you see some good information here. And it also tells you that the risk potential is moderate. Okay. So there's low risk potential, moderate, and high. And as you can see, some of these are higher. Okay, so I just wanted to look at one of these so that you can find for yourself, what these funds are, and every company like this should give you a tool like this to be able to look at it. So I'm going to go into the second one there. That is, well, actually, let me see. I'm going to go into this Communications and Technology Fund. All right. So that has a higher risk profile, largely because it's invested in tech. The returns can be higher, but the losses can be big too. Okay. So what you see there on the Communications and Technology Fund is that if you look at the year-to-date return, it's 32%, right? 1 year, 45%. Okay. But when you look at a 5-year average, it's 14%, and so, since inception, which it came into being in 1993, it tells you when this fund started. And so basically that 14% is what it has returned over its entire lifetime, right? So if we click on the Communications and Technology fund, it will bring up quite a bit of information about that. Now, I'm not recommending this. I'm just showing this for illustration purposes. This is just so you can see where you can actually find this information yourself and you can get a feel for it. So part of your journaling exercise is look up some mutual fund companies and look at some of the funds that they have and what their investing strategies are, etc. Okay, so this will tell you, this is the ticker. If you wanted to look up the ticker symbol, this is what it would cost to buy a share of this fund. Okay, it's $158 and some change right at the moment. Okay, so it gives you that Morningstar rating. It tells you what the strategy is. So basically, it tells you that this fund is invested in communications and technology companies. Okay. It also tells you what the risks are, and these are just typical things that there's always risk in the market. That's just a given. You have to accept that. It also tells you here who the fund manager is and how long that person has managed the fund, so you could always look up more information about that person. You'll see all those annual total returns, etc. So of late, this has had really good performance for a while. But like if you keep scrolling down, you'll see calendar year total returns, so like in 2022, this one did not do well. Okay. It had, big losses in 2022. And we would have to look at why exactly that happened, kind of who they're invested in. Sometimes there are years that are sort of outside the norm. Okay. You'll see that generally speaking, this is a positive return mutual fund. It has done really well over time, but you have to start getting a feel for yourself what these charts are telling you, and does it give you confidence that you want to invest in it? So for example, for one way that I look at this is like, okay, as I've said before, I'm 60 years old as of recording this. And, so I might have small bits of money in a higher growth, higher risk type of fund like this, but most of mine are probably going to be in safer ones. Now, if you're 20, you might want to put a little more money in this, but you've got to decide for yourself. Is it 20% of my investable assets? Is it 30%? Just how aggressive do you want to be early in your career, earlier in your life? So, I was heavily invested in tech early in my life because it was a great way to make money. I was getting 30% returns back in the day, which really helped to grow my retirement funds. Okay, so now we get down to some of the really cool information here. So for example, this money manager is managing over $9 billion of money. It's a lot, right? And so they're tied up very heavily in US domestic stock. There's some foreign stock. They've got a little bit of cash on hand, and and then they give you the sector allocation. 30% is tied up in the internet-based companies. For almost 15% is in software companies. So you see sort of the sector allocation. So they've got internet, software, telecom, media and entertainment, semiconductors, hardware, so all kinds of things technology related, as well as some financial services are thrown in there. Okay. And then over, you will see their top 10 holdings. So these are the top 10 companies with the most stock that they're invested in. So they're in Facebook or Meta, they're in Netflix, they're in Apple, Alphabet is Google, Microsoft, T-Mobile, which is a telecom company, Amazon, Nvidia, AT&T, and Mercado Libre, which I think is a Brazilian company, I think, which I think they're financial. But you see now that, okay, they've got 8% of their money tied up in Meta or Facebook. They've got 7% tied up in Netflix, right? But at any given point in time, this professional money manager can decide, ooh, maybe Facebook is not doing well. I'm going to close my position there and move that money over to somewhere else. That's what they are there for, right? So part of your research may be, I'm going to look up this person who's managing this money. What is their history, right? Get to know a little bit about them, if there's any information out there. But these are the kind of things that you want to be starting to think about, right? And so because they're investing in a lot of different companies, they're diversifying right off the bat. Now, they are a higher risk because they're going for companies that can have high rewards and also high or big losses. Generally speaking, technology companies have done very well, and they're almost like a cash cow. Most of them are. The kind of money that they generate is really amazing. Okay. So essentially, what you want to start to think about is, how will you diversify? Part of that will be learning different investment types, learning what kind of fits with your personality and your goals. Okay. And frankly, and we'll talk about this on some future episodes, you don't have to be necessarily aggressive, to build a really nice income stream for yourself in your retirement, to have a decent sized portfolio by the time you retire. The real key is that it just takes time, and you have to do it consistently. That's really the magic of investing and managing your money. Okay. All right. So thanks a bunch, and I'll talk to you soon.